Do you know with REITs, you can own a shopping mall such as Pavilion, KLCC or even Mid Valley with just 100 ringgit. You can even earn dividends from as high as 8% yearly. Sounds crazy, right? But that is the power of investing in REITs. Looking back at a video about passive income, many of you are interested in REITs. So in this video, I'll break down what REITs are, how to analyze them, and why they might be better than buying a physical property, in my opinion. Also, stay to the end because I'm going to show you step by step how to buy local and overseas REITs. So what exactly is a REIT? REIT stands for Real Estate Investment Trust. It's basically a portfolio of properties that generate income like shopping malls, hospitals and warehouses. And often these are rolled out by property developers such as Sunway. So instead of buying one property yourself, you can now invest in a share of this property and earn a slice of the rental as a passive income. Now, back in the day, people bought properties to rent them out, collect rental and wait for them to go up in value. Well, you can do exactly the same with REITs now. You can even invest in it for as low as 100 ringgit and receive dividends from it as long as your REITs make money. There are multiple categories of REITs such as healthcare, warehouses, shopping mall, and they all function like a stock listed on Bursa Malaysia, and you can sell them anytime to take profit as long as you have a brokerage account. Last but not least, REITs are managed by professionals, and by law, they must distribute at least 90% of their taxable income to shareholders. This means that if their property makes money, you will get a portion of it, usually in the form of dividend paid out quarterly or semi-annually. So REITs come in different categories and each one behaves differently depending on the type of property that they own. So the first one, there will be retail REITs. Retail REITs mainly own shopping malls, retail related property. For example, Pavilion REIT. As you can see, majority of the property under it are shopping malls like Pavilion KL, Pavilion Bukit Jalil and Taman. The draw for retail REITs is that you can own a piece of a shopping mall and you can earn dividend from it as long as the shopping mall does well. This is because when there's more tenant, more footfall, more store, more rental collected and more dividend for you. Fun fact, do you know the tenancy agreement in the mall? It's kind of a hybrid one, not like normal residential, just collect a fixed amount. When the shop makes money, they get a cut out of their revenue as well. Ching ching! Yeah, that's why when the mall is doing very well, haha, you also make more money lah. Now you know why. Next one, healthcare REIT. Those are Aka REIT and IHH. For them, most of their property under them are hospital and healthcare related properties. So healthcare REITs tend to stay relatively strong even during crisis. So give you an example, right? Our Aka REIT, even when COVID happened, everything in the stock market crashed, our Aka REIT's share price kind of stay relatively stable compared to other people. This is because even when crises such as COVID happen, people still need to go to hospital. And no matter what, this means technically, hospital kind of earn a little bit more money during that time as well because COVID ma. And one thing interesting about healthcare REIT is this. In Malaysia, we are an aging population, which means that in future, there are going to be more old people than young people. Because people don't want to give birth. What to do, right? So, and most of us, as we go older, we will need to go to the hospital for healthcare. That's the benefit law. Then you also have industrial REITs, where the majority of the REITs under it are like warehouses, factory and so on. With the e-commerce and online shopping market is expected to grow towards USD 325 billion by 2028. We know that warehouses and so on have good demand, especially in Malaysia because we are one of the natural hub for regional e-commerce. Now, fun fact, during COVID time, Axis REIT is one of the top industrial REIT in Malaysia, dropped 17% in 1 week. But in the short 2 months, they recover back their market value because during COVID, e-commerce exploded and there's an increase in revenue. So yeah, for those of you who believe in industrial growth and commercial growth, well, industrial REIT is one of the interesting places to put your money into. Now, let's talk about diversified REITs. This means a REITs that own a piece of everything. Take for example, Sunway REITs. It has malls, hospital, hotels, and even office building. So this kind of portfolio helps to spread out the risk lah. So even when one sector underperform, the other sector can cover the difference. Such as if offices don't perform well but hospital perform well, then gotta cover back. Diversified REITs has diversified risk. But I have to say, diversified REITs are also harder to evaluate because there's so many different sectors inside the REITs, right? You do not know which one will do well, which one will not do well, and then if one do well, the other one don't do well, then it kind of pulls it back, right? So while it's diversifying the risk, it also diversify your earning. But this is on personal opinion lah. So personally, I prefer REITs that are more focused, like healthcare or retail REITs, because there are less things to analyze compared to diversified. I just need to know whether healthcare sector is doing well, then generally the REITs will do well. I know industrial will do well, then industrial REITs will do well. I don't need to know everything and everything doing well together. Nonetheless, each category of REITs have their own strengths and weaknesses as they all perform differently based on the country's economic condition and development. Now, if you're interested in investing in REITs, here are some things that you have to take note of first. Firstly, interest rate. They are very sensitive to interest rate. So how does this work leh? If the government decides to raise interest rate, REITs will go down in value. This doesn't happen to REITs only, but any physical property as well. Why? This is because property heavily relies on bank loan. And with rising interest rate, loan become more expensive and affect the revenue of developer. So generally, REITs tend to go down in value in a rising interest rate environment. Second, although REITs have to distribute their earnings as dividends, but when REITs don't make money in bad economic condition, there will also be no dividend payout law, so as simple as that. Third, there are much more to analyze about REITs. In fact, you need to learn how to read their annual report and you need to understand the technical information behind REITs. So if you're interested to invest in REITs, you have to know how to analyze REITs, and here are some tips. But let me give you a warning, this part can get a bit technical, so you may want to slow down the video a little bit and give me some time to explain. First, you have to know what is a dividend yield. The dividend yield basically tells you how much of income you can get compared to the share price at that time. So for example, if a REIT gives you a RM 5 ringgit dividend per year and the current price is 100 ringgit, that's a 5% dividend yield. And one thing you have to take note of is for Malaysian REIT, there's a 10% withholding tax on dividends. So if it says 6%, you will only get 5.4% net into your bank account. If you wonder who is getting that tax money, well, the answer is HDNO. Dividend from REITs are taxable income. Also, one thing about dividend yield, when you see a high dividend yield, don't get too excited, alright? Because while a high yield might mean good income in terms of percentage, but it also could mean that the share price has dropped because something is wrong, right? So here's the thing, right? Malaysian REITs generally pay around 5 to 6% in dividend one. So if you see 8%, you might want to do a thorough check to see why is it giving such a high yield. Quickly check their company report or the news to see if there's any reason that people are selling it, leading to the value of the share dropping. Don't just chase high number, always look for other indicators as well. Nonetheless, here are some other indicators that you want to check. So let's go. Number one, occupancy rate. The occupancy rate shows how many of the REIT's property are currently rented out. The higher the occupancy rate, the more rental income. A REIT with 98% occupancy is way better than one with 70% rented out, right? Imagine owning a mall where half of the shop are empty one. Confirm income also not steady lor. Next thing, gearing. Now, this one a bit more technical, but stay with me, okay? In simple terms, gearing ratio shows how much debt a REIT is using to fund their property. Okay, think of it like this. If you want to buy a house that's worth 100,000 ringgit, you can choose to pay by cash 100,000 ringgit, or you can choose to take a loan to buy the house where you only pay, say, 10,000 or 20,000 ringgit down payment, then the remaining take loan. That is what we mean by gearing. So, for REITs, this is how it works. If a REIT owns 1 billion ringgit worth of property but owe the bank 400 million, the gearing ratio is 40%. So in Malaysia, REITs are limited to a maximum of 50% gearing by regulation. Why? Because higher gearing means higher risk. So about 50% means 50% loan, 50% their own money, also lower risk. Anyway, ideally you want to invest in a REIT with a gearing about 30 to 40% or even a little bit lower lah. Why? Because lower gearing means less risk if interest rate go up. Remember earlier we said REITs are very sensitive to interest rate. So if a REIT has high gearing, interest rate go up, their value will drop even more because it's going to be more expensive for them to finance those property. But if their gearing is low, if interest rate go up, their price will take less hit because their cost will not be that affected. Now, next one is Fund from Operation, or FFO in short. In simple term, FFO tells you how much real cash flow the REIT is making from its property. Because when you look at the normal traditional financial reports, right, the profit usually will include things like property revaluation gains, accounting adjustment, all this kind of stuff which is not real cash coming in. FFO tells you the real operating profit from renting out the properties. So the higher and more consistent the FFO, the stronger and more reliable the REIT is at generating real money to pay you dividends. So in short, you want to look for a REIT that has a growing FFO. The best is every year got growth because that's good sign, right? It means their rental income is increasing, growing, and they're managing their property very well. Now, another thing you want to check for is the REIT's average leasing expiry. In short, ALE. This ALE basically tell you how long the tenants are locked into their leases and if the average lease expiry is short or long, like 1 or 2 years or 3 to 5 years. If let's say the ALE is too short, it means that things could be very volatile because once it ends, they need to find new tenant. And what if by that time there is a market crisis, then people don't want to rent the place. So basically it all means more risk. When you have longer ALE, it means there's more stable income coming in. However, you do not want extreme in both ends lah. Why leh? Because think about it, if it's too short, then something happen in the near future, then you can't collect continuous rental, right? Because there's high risk. But if it's too long, then you keep renting out at the same price, you may miss out the price growth for rental. So you want to find something that's ideally balanced. It is long enough and short enough. I would say it should have a combination of short-term leases and slightly longer term leases. So the next thing to look at is how many properties these REITs own and what kind of property and who's renting them. Okay, to give you a good example, imagine a retail REIT, but it only owns one mall and one tenant. How risky that can be, because if that one tenant cabut, the income straight away drops. So the best kind of REITs generally have a diversified portfolio, not so much in the terms of industry, but rather many different property with a mix of tenants and location. So it's kind of like if one shop closed down, the other shop still can pick up, right? So let's say you are interested in an industry focused REIT like healthcare, you pick one that has many different hospitals and one that is a quite good business in all their different branches so that you can ensure that their rental income and operational income is stable. Okay, last but not least, let's talk about management quality. Basically, we are talking about the team that is managing the REITs. Look at their track record. Is their portfolio growing, like building properties? Are they consistently paying dividend? Are they transparent in their reports? You can usually find this kind of information in their annual report, especially under the manager's report or message from the CEO. A well-managed REIT will always have focus on growth steadily, maintaining good occupancy and keeping a healthy balance sheet, like gearing ratio that's low. So a bonus tip for this, just Google the REIT name plus investor relation and you will find all the official reports, earning presentations and fact sheet. It's all there for free. So now that you know how to analyze REITs already, let's talk a little bit about global REITs, because although Malaysian REITs are great but if you want more diversification and access to stronger market, you can take a look at the global market, the overseas REITs, and it's quite fun. So let's say you're interested in investing in property in US, you can check out US REITs. For example, there's Realty Income REITs. It's one of the oldest REITs in the world, by the way. They pay monthly dividends, owning over 13,000 properties, including 7-Eleven. Oh, by the way, do you know that in US there's also billboards REITs? Yes, billboards. Those, when you drive on the highway, you see the big billboard. Yeah, that one also got REITs, So you get rental income when companies rent those billboards to put up their advertisement. And one more fun fact, in US, there's also prison REITs, right? So think about it, even prison also got REITs. For example, Core Civic. Yes, in US market, there's much more choices when it comes to REITs. There are all sorts of different kind of things. More variety compared to Malaysia, since America kind of literally invented REITs in the first place, right? Then, let's say you're interested in Hong Kong REITs. There is this thing called Link REITs. They're the largest REITs in Asia. It started with just wet markets, shopping centers, but now it has assets in China, UK, and even the Queen Victoria building in Australia. So what this means? It means that if you invest in a REIT like Link REITs, it doesn't only give you exposure to Hong Kong properties, but it also give you overseas markets as well. Quite a complete global REIT. And another fun fact about Hong Kong REIT is this: because they are so close to China, they can easily tap into the China market. In fact, their market grew so quickly in the early stage because of their property in both Hong Kong and China. And one more important thing that will make you love the Hong Kong REITs is this: they are not subjected to any withholding tax, even if you're a foreign investor. Next, Singapore REITs, our favorite neighbor, also known as S-REITs most of the time. Now, their country is known for strong government, strong growth, stability, and most importantly, lack of land. So generally, many people say when you want to buy real estate in Singapore, sure make money one. Not I say one, other people say lah. So nonetheless, as a Malaysian, if you want to have property exposure in Singapore, you cannot go down and just straight away buy property. It's so expensive, and then some more such a high tax. So by buying S-REITs, you get to own a piece of Singapore. And not just that, very often their REITs have a combination of assets across China, Japan, Europe, and United States. Quite global actually. And the best part is, it is also zero withholding tax for foreign investors like ourselves. Unlike if you go there, you buy a physical property, you will need to pay quite a lot of tax. So why are we talking about global REITs? Well, one of the main reasons is because it gives us access to other currencies and a diversified economy. So instead all your money is in Malaysian ringgit, right? You get to have your money in all the different sort of currency. So this kind of works as a hedge in your investment, right? Sometimes like people say, even without the value of the investment go up, the currency value already you make money. And at the end of the day, you want to protect your investment, right? If this one country go down, everything go down together. At least your money is spread across the globe in different markets. Okay, now that you understand REITs and how to evaluate them, here is a step-by-step on how to buy them. I personally prefer to use the MooMoo app because not only you can invest in Malaysia REITs, but also global REITs like the US, Singapore, and Hong Kong, all those that I talked about just now. And you can still receive all your dividend through MooMoo. Plus, their commission, their fee is highly competitive, one of the lowest in the market, okay? So let me run through with you how you can do it via the MooMoo app. First, you need to open an account if you do not have one. So use our code MMTV40 and check out the link in the description below. I'll teach you later on how to get more rewards from signing up. But let's talk about the REITs here first, okay? Let's say you want to buy Malaysian REITs. Click here to see all the REITs listed in Malaysia. And here you can filter all the REITs by market cap, dividend yield, and price change. Say for example, you want to buy Sunway REITs here. Click here and you can see all the company details, dividend yield, and so on. If you're satisfied, just click trade. That's the amount you want to buy. Once done, click buy. Now done, you've just bought your first Malaysia REITs. It is that simple. But what if Malaysia is not enough? You want to buy Hong Kong REITs or Singapore REITs, other country? Well, the process is the same. You can simply select the country here and explore which REIT you want to buy. If you already have one in mind, a specific REIT, for example, American Corporate Tower, you just type it in the search bar here and boom, you can buy with the same process. So again, if you're a new user, you can use our code MMTV40 to sign up. And currently, MooMoo is offering up to 1,900 ringgit in rewards, including Nvidia share worth 1,800 ringgit. Other than that, if you deposit 1,000 ringgit, you can get 40 ringgit cash reward. And guess what? All these are stackable, alright? Okay, one more thing. Even if you're not interested in investing in REITs, there are many tools in this MooMoo app that you can use. For example, here, if you go to Discover and click Insights, you can find out special insights curated by MooMoo, like Warren Buffett's holdings or how to beat EPF and ASNB. You can see which stocks are inside the holdings, how it performs and such. So If you feel like copying the investment strategy of people like Warren Buffett or these super fund managers, you can choose to buy the same stock as they have. That's not it. There are other useful tools that I like as well, such as investment team here, where I can sort out the stock related to the themes for you. These help me save so much of time in researching stock that relate to the theme that I am interested in. Last but not least as well, if you're ready to deposit money and start investing, you can all get an exclusive reward from my MooMoo code MMTV40 by searching exclusive deposit here. Click join now, select the amount you like and click deposit. Then you're done. Well, that's all about MooMoo. Now back to our topic. So, which one should you invest in? REITs or physical property? If your goal is to buy a house or live in it while enjoying the benefit of prices going up, buying a physical property makes a lot of sense because ultimately you will have a home to live in. But if you're just taking a 35-year loan to buy a condo, to rent out and flip it for a profit, well, I personally think that REITs might be a better option for many of you out there. This is because buying a physical property is such a long and heavy process. Bank loans lah, monthly commitment lah, maintenance lah, finding tenant lah, rent lah, all these things, there's a lot of work. Sometimes we think about physical property investment too simply. We forgot to factor in all this hard work that we need to put in, and at the same time, there is a lot of risk involved because once you decide on one property, it's a 35 years thing. So even when market change, you can't exit that simply. Unlike buying REITs, it is very liquid. If you made a good decision, you can take profit anytime. But if you made a bad decision, you can still exit quite easily. And more importantly, you get to receive dividends as passive income, just like rental income, with no hassle. So you get all the benefit of a property, but without the hard work of a property. Now, some of you might say right now, but here's the difference. Buying a property can take loan, okay? You cannot take loan to buy REITs. So that leverage is power. Well, that's true, but not everyone can take out a loan to buy shopping mall or hospital, right? So REITs is a tool that can give you option to buy more kind of property. In fact, in my last week's newsletter, I kind of talked about moving away from investing in residential property and leaning more towards commercial and industrial property. In short, this is because Malaysia is experiencing a population decline, and I personally think that residential property's demands are highly tied to population growth, right? At the same time, even if populations shrink, businesses can adapt and it will still go on. So commercial, industrial and healthcare property has a stronger advantage in my personal opinion. And to get access to that, buying REITs seems to be the few ways of doing it. So with that in mind, I do think REITs is a good starting point for many people. Ultimately, you still get passive income from it, right? So if you're interested in my thoughts related to all sorts of investment, consider subscribing to my newsletter where you will receive it on a weekly basis. Now that you understand REITs and how to earn passive income from it, here's also a retirement calculator app that I built recently to help you calculate how much exactly you need to retire without any guesswork. Comment the fire icon down below if you want me to make a video about retirement planning. Also remember, my videos are for education, not for financial advice. So if you're thinking about investing in any of the REITs that were mentioned, please do your own research. It is not investment advice at all. If you found this helpful, hit the like button and I'll see you next week.